time for business. We say hello to Kate Moody.
Hi, Francois.
First, it was these two U.S. mid-sized banks. Now it's Switzerland's second biggest lender.
Yeah, worth pointing out that there are different problems that have dogged the two, but certainly making for a very, very volatile session on the markets. Credit Suisse plunging to a record low, dragging other European stocks with it. Now, Credit Suisse has been one of Europe's more troubled lenders in recent years. A series of compliance problems and huge losses last year have prompted it to outline a radical restructuring plan, including 9,000 job cuts. Customers have also been withdrawing more money than usual, over $130 billion worth in 2022, mostly coming in the last quarter. Now, this Tuesday, the bank scrapped bonuses for top executives and it acknowledged material weaknesses in its financial reporting. Then on Wednesday, its biggest investor, the Saudi National Bank, ruled out further financial assistance by increasing its stake beyond its current 9.9%. Now, banking stocks had already been rattled this week by the failure of two American lenders, although these issues dogging Credit Suisse are largely unrelated. The chief executive insisted on Wednesday that its cash position remained very, very strong. Nevertheless, Credit Suisse shares plunged as much as 30% this session, down 25% at the closing bell. This is the picture over the last year or so. You can see their share price has already lost some 75% of its value over the last 12 months. Those jitters dragged down other European lenders as well. French banks Société Générale and BNP Paribas down over 12 and 10% respectively. Germany's Deutsche Bank down about 10% as well at the close. We do understand the European Central Bank has asked the bloc's banks to report how exposed they might be to Credit Suisse. The ECB will likely address instability in the banking sector, as well as a decision on whether or not to raise interest rates. That'll be happening at a meeting in Frankfurt on Thursday. Well, I've been speaking to Nicolas Veron from the Peterson Institute in Washington. He said that European banks may be in for a volatile ride, but largely unrelated to the recent collapse of America's Silicon Valley and Signature banks.
For example, today we see a lot of turmoil at Credit Suisse, which is not in the EU but in Europe and Switzerland, and they announced material misstatements in their financial publications, which is a big issue. But that situation had been developing for some time, and it's not directly linked to what's happening in Silicon Valley. So, you can have risk materializing in the banking sector. The banking sector is full of risks. That's why it's subject to regulation and supervision. But I think not all these issues are connected.
Let's check in on the rest of the day's trading action now. The banking sector was down an average 7% across Europe. That dragged down the major European indices. Losses of over 3% in each London, Paris and Frankfurt, more than 4.5% in Milan. Wall Street's also trading firmly in the red. Investors there worrying once again about their exposure to possibly weakening banks. Oil prices tumbled over 6%, heading for their worst day in over 6 months. Well, just months after a botched mini-budget sent the British pound into freefall, UK Prime Minister Rishi Sunak's government has unveiled its own spending plans for the year. The finance minister saying the economy would contract slightly this year, but avoid a widely predicted recession, and that inflation would slow drastically from its current 10.1% to just 2.9% by the end of this year. Among the proposals outlined by Jeremy Hunt this Wednesday, extending a cap on household energy bills to help with the cost of living crisis and more funding for childcare in an effort to fill over 1 million job vacancies. The budget proposal would also ease rules on pension savings to allow workers to put more money in the bank, and it would hike the corporate tax rate from 19% to 25%. Meanwhile, hundreds of thousands of teachers, doctors, transport workers, and others staged yet another day of nationwide strike as they called for a hike in public sector wages. Analysts say the so-called cost of living budget hasn't addressed their key demands.
So it is interesting that we've got strikes going on today at the same time that the budget is released and at the same time that they don't announce any public sector pay rises. It's certainly the elephant in the room. If the government isn't willing to pay the price of labour as it's been set by the workers, then we're just going to see declines in the productivity and declines in the output of our national services.
Much more on that story to come in the days and weeks ahead, Francois.
All right, many thanks. Kate Moody, who will be keeping an eye on those financial markets for our next edition.